Hello everyone, welcome to this session of IFRS 15 Revenue from Contract with Customers. My name is Karan Saigal. In today's session, we're going to discuss on step 3, which is determine the transaction price. In this session, we'll have an overview of the transaction price. We'll discuss what do we mean by variable consideration, what is a non-cash consideration, and consideration payable to the customers, and few case studies around variable consideration. Let's understand what is the transaction price. Transaction price is the amount of consideration to which entity is entitled to in exchange of promised goods or services, excluding amount collected on behalf of third party. The transaction price can be fixed or variable. The entity needs to calculate the transaction price at the inception of the contract. The transaction price will be often the amount specified in the contract. The entity also needs to consider the historical practices in determining the transaction price. In determining the transaction price, the entity needs to consider the following. Does the contract have any variable consideration? Is there any significant financing component? Are there any non-cash consideration? Or is there any consideration payable to the customer? Each of these items impacts the calculation of transaction price. For the purpose of determining the transaction price, it should assume that all the goods or services will be transferred to the customer as promised in the contract, and the contract would not be cancelled, modified, or renewed. In this slide, we'll discuss about variable consideration. Sometimes the consideration is not the value which is mentioned in the contract. This is because of several factors in the contract which makes the consideration variable. Few examples are discounts, rebates, right of return, and price concession. The consideration can also be dependent on certain occurrence or non-occurrence of future events. There are implied or customary business practices that makes the consideration variable as well. The entity needs to go through the contract and identify all the terms and conditions and also consider the customary business practice while estimating the variable consideration. If the contract includes variable consideration, then the entity needs to estimate the same. There are two methods which helps entity to estimate the variable consideration: the expected value method or the most likely method. The entity needs to choose any one of the methods to arrive at the variable consideration. The expected value method can be used when there are a large number of contracts with similar characteristics. The value is calculated as a sum of probability weighted amounts in the range of possible consideration. The most likely method is appropriate when there are only two outcomes: the single most likely amount in a range of possible consideration amounts. There are few points which needs to be kept in mind. Firstly, selecting one of the above method is not a free choice, and the entity should use the method that provides the better estimation model. Once the entity has selected one method for a particular kind of contract, that needs to be applied consistently to all similar contracts. When a contract has more than one item of variability, then the entity can use more than one method to estimate the variable consideration. Let's discuss on another topic, which is constraint of variable consideration. The variable consideration should only be included in the transaction price to the extent that it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not happen. Few of the factors that needs to be considered and which might increase the likelihood or magnitude of revenue reversal are as follows: the amount of consideration, which is highly dependent to the factors outside the entity's influence; the uncertainty about the consideration is not expected to be resolved for a long time; the entity has a practice of providing broad range of price concession; the contract has a broad range of possible consideration amount. Now let's look at a case study which will help us to understand variable consideration in a better way. A enters into a contract with B to provide a printer and a post-contract services for 2 years. The price of the printer is $100 and the price of the post-contract services is $25 for each year. The contract also states that in case there is any problem with the printer and the engineers of A are not able to fix it within 48 hours, then A would end up paying a penalty of $10 for each of such scenarios. Now, when A calculates the transaction price, it's clear that the price of the printer is $100. The price of the post-contract service is $25 into 2, that is $50. When A analyzes the average time it takes to solve problem with the machine based on the historical data, it estimates that on an average the printer has a problem 3 times in a year. Out of 3 times, 2 times the average resolution time goes beyond 48 hours. So A estimates that during the duration of the contract, there would be 4 times A would end up paying penalty to B because the resolution time goes beyond 48 hours, and the amount of penalty will be equal to $10 into 4, that is $40. So the total transaction price for this contract would be $100 for the printer, $50 for the post-contract service, and a reduction of $40 for the estimated penalty which A might end up paying to B for the contract. So the total transaction price would be $110. Let's look at another case study related to price concession. A enters into a contract with B to transfer 10 mobile phones. The price of each phone is $25. A and B has been doing business for the past 5 years, and A has been providing an additional discount of 10% for all the transactions on and above the price mentioned in the contract. In this case, when A determines the transaction price, there is no mention of the discount in the contract. However, since there has been historical practice of providing a discount, B has a valid expectation based on historical practices. This means that when A calculates the transaction price, it will factor in the 10% discount on top of the price of the phone, which is $25. So the total transaction price will be 10 mobile phones into 22.5, which is $225. Let's look at another case study related to bonus. A enters into a contract with B to provide a printing machine. The price of the machine is $10,000. As per the terms and conditions of the contract, in case the printing machine helps B to reduce the existing printing cost by 10% per annum, then B would pay a bonus of $500 for each year throughout the life of the machine. The expected life of the machine is 5 years. When A calculates the transaction price, there is a variable element in it. Based on the past historical practice for the transaction related to printing machine, A is able to save 12% cost per annum in similar kind of customers and contracts. A is certain that it would receive the bonus of $500 for 5 years. So the transaction price in this case would be $10,000 of the printing machine and $2,500, which is the bonus A expects to get. So the total transaction price would be $12,500. Now let's look at a case study for volume-based discount. A enters into a contract with B to transfer 100 phones at a price of $25 each. As per the terms and conditions of the contract, if B buys in total over 120 phones, then A would provide a discount of 10% on the overall transaction price. The contract is valid for 1 year. When A calculated the transaction price at the inception of the contract, it is not certain that B would buy 120 phones. A calculates the transaction price as $25 for each phone. In the first 3 months, A transfers 75 phones and estimates to transfer another 65 phones in the next 9 months. As the total number of phones to be transferred is over 120, it means that A would provide a discount of 10% on the total transaction price. The new transaction price for the whole contract would be 140 phones, which is 75 phones transferred in the first 3 months, and 65 phones to be transferred in the next 9 months. So 120 phones into 25 into 90%. That is 3150. As of today, A has already transferred 75 phones at $25 each. So the total transaction price recognized till date is 1875. The remaining transaction price would be 1275, and this would be divided by the remaining phone which would be transferred, which is 65, and the transaction price for each phone would be $19.2. In this slide, we'll discuss about significant financing component. This is a very interesting concept. Sometimes the payment made as per the terms and conditions in the contract is different from the timing of revenue recognition of promised good or services. Moreover, the cash selling price of the good or services is different from the price stated in the contract. This can be due to a financing component which needs to be segregated from the transaction price by applying the concept of time value of money. The objective is to recognize revenue which reflects what the promised cash selling price of the good or services should be if the customer would have made the payment when the good or services were transferred. The discount rate to calculate the financing portion should be the prevailing interest rate in the relevant market. The rate should be determined at the inception of the contract. As a practical expedient, an entity is not required to adjust the transaction price when the gap between the customer payment and actual transfer of goods or services is less than 1 year. The financing component can exist in any of the following ways. First, if the payment is made in advance by the customer and the gap between the payment made and the transfer of goods or services is more than 1 year, in this case, there would be an interest expense. The second case, if the payment is made after 1 year of transfer of goods or services, in this case, the financing component would have interest income. The contract will not have financing component if any of the following factors exist. An entity receives an advance payment and the timing of transfer of goods or services is at the discretion of the customer. A substantial portion of the consideration is variable and the amount or timing of the consideration is outside the customer's or entity's control. The difference between the amount of promised consideration and the cash selling price of the promised good or services arises because of non-financial reasons. The next concept is non-cash consideration. Non-cash consideration received from the customer is measured at fair value. If an entity cannot make a reasonable estimate of fair value, then it refers to the estimated selling price of the promised good or services. Consideration payable to the customer includes the cash amount an entity pays or expects to pay to the customer. The consideration payable to the customer can include credit or other items that can be applied against the amount owed to the entity. The consideration payable to the customer would result in a reduction in the transaction price unless the payment is made for distinct good or services. If the payment made by the entity to the customer is for distinct good or services, then it would be accounted as a separate transaction. However, if the amount paid exceed the fair value of goods or services transferred, then the difference between the fair value and the amount paid to the customer would be reduced from the transaction price as consideration payable to the customer. If the entity is unable to assess the fair value of good or service, then the full amount should be reduced from the transaction price. If the consideration payable to the customer is accounted as a reduction in the transaction price, it is recognized when the later of the following event happens. The entity recognizes the revenue for the transfer of the related good or services to the customer, or the entity pays or promises to pay the consideration. Now, there are a few important points to be kept in mind. If there are any payments made to the customer that are not specified in the contract, it may still qualify as a consideration payable to the customer. An entity needs to evaluate all such payments and assess whether it is made for any distinct good or services and needs to be recorded as a separate transaction or will it result in a reduction of revenue. This would be very judgmental. The consideration payable to the customer can include payment made outside the direct distribution channel. So an entity can make the payment to the end customer in the distribution channel and still it will result in reduction of transaction price. Another important point to consider is that if there is any customary business practice to provide rebates, discount to the customer, then entity need not wait for the program to be announced. Based on the historical practice, the entity would make an estimate and accrue for this discount, that is, reduction in the transaction price, when the good or service is transferred to the customer. Well, this brings us to the end of the session, which is step 3, how to determine the transaction price. And the concepts we covered in this session was variable consideration, constraint to variable consideration, significant financing component, non-cash consideration, and consideration payable to the customer. In the next session, we will discuss on step 4, which is allocation of the transaction price to the performance obligation. Stay tuned for the next session. Thank you.